All right, let's go ahead and get started. Today is Monday, April 17th, 2 p.m. section. This class is being recorded for publication for the rest of the classes. So today we're going to talk briefly about the last homework assignment, homework 11 on Royal Caribbean, and then we're going to spend most of our time on multiples, which will not only be homework 12, but also your fourth group project that will be coming up. But before we get into that, just very quickly, wanted to do a quick check-in on Bloomberg and the trading challenge. We're about halfway through the second half of the semester sprint. Just looking at section 301 today. All right, so the good news is everybody's under $300,000 of available cash, which is important. And everyone in this section has made the minimum 10 longs for the second half of the semester. So this would be the ranking as of today. So you want to see where your team is. So it's pretty straightforward, but any questions about the trading challenge? All right, so 1 week from today, your teams will be presenting Group Case 3 on valuation. As I've said before, the company is Nokia. So next Monday morning, you're going to submit 5 files in advance of that presentation. Okay, you're going to submit the PowerPoint with all the data that you're going to present, and you're going to submit your 4 Excel models for Nokia, the as-is, the bull, the bear, and the target. However, all of that data that's in those 4 Excel files has to be put into the PowerPoint. I'm not going to let you jump from the PowerPoint to the Excel. If you go outside the PowerPoint, I'm just going to stop listening to whatever you're saying. Okay, so you have to present it in that Excel file. So when you are explaining, for example, your as-is, and here's the assumptions I use for the as-is, you should have screenshots from the ratios and assumptions in the PowerPoint that you're going through. You also must have the screenshots that are required for the as-is, the WAC, the EO, the DES in that PowerPoint file as well. Okay? Now, I'll put up a couple of sample presentations later this week that teams in past semesters have done to help you figure out the structure for what I'm saying. But the important part is you're going to be presenting a 10-minute PowerPoint. Make sure in 10 minutes you cover all 4 models for Nokia, use numbers, all data in that PowerPoint presentation. That's Group Case 3 next week. Again, context is important beyond numbers. So you see a big jump in goodwill, who'd Nokia buy? Okay? And you got to get that valuation done. All right, questions about Group Case 3 due next Monday that you'll be presenting. So that'll be our next Group Case class. All right, the other thing that's going to be due next Monday is homework 12. And just a word about homework 12. It says it's extra credit. Let me tell you what that means. You still have to do it. If you don't do homework 12, you're not going to be able to opt out of the final exam. So you still have to do the extra credit homework. However, ELMS, unfortunately, is not set up to have more than 100 available points in a semester. If you do, it just freaks out. All right, and that's what's happening, is that there's now more than 100 eligible points this semester in the class. All right, so any points that I give for any assignment are now what I call extra credit. All right, so your grade is based on 100 points. Okay, so it's not based on a percentage of total, which means to get an A in this class, you need 93 points. As of today, there's 103 available points to get 93. Okay, so the extra credit can only help you in terms of your grade. It doesn't hurt you, so it's not scaling in any way. All right, so I'm just adding more potential points to the population. So let's say you missed an assignment earlier, your team didn't do so well on a project. All is not completely lost. Keep doing these extra credit assignments. That's an opportunity. You also have the homework replacement, which you can do anytime between now and the first week of May for an individual assignment. Okay? But basically, you're going to have to do a multiples analysis in a paper, which we're going to cover in class today. Next Mondays, it's going to be due as well. Okay? So in order to get all the data for your multiples assignment, in order to get and finish all of your data for Nokia, Wednesday is a Bloomberg Lab Day. Okay, so there's no more lectures. Actually, after today, this is really the last lecture for the rest of the semester in terms of content. Okay, I don't have a lot more content to go over with you. All the readings of the book have been completed. Everything we're talking about we'll finish up today. We'll do more application and practice, But that's really what we're going to be doing the next few weeks, application and practice. Okay? So, questions about any of that? All right, let's talk about Royal Caribbean. For your Royal Caribbean valuation, the key here, when you did the as-is, was the continuing value ROIC. If you followed the process that we've been doing for other companies, and you put in the basic analyst consensus and ratios and ran them out for 2022 going forward, the problem is you likely got a negative spread. You got an ROIC that was at or below the WACC for Royal Caribbean. And I'm telling you, you're not going to get a big valuation for a company when you grow a negative spread. So you either have to put in some crazy, weird negative growth rate, or you're going to have to change that spread. And so this is why we're doing some exceptions here, but Royal Caribbean is an exception where we're going to have to come up with a continuing value ROIC that is a positive spread. And if you don't do that, you would not have been able to get a reasonable as-is valuation. Right? So that's why I chose this company for us to work on. Right? Because again, most of the time, you do a company like a Costco, a Walmart, a Target, somebody like that, or Merck, their future looks a lot like today. They already have positive spreads, so they're relatively straightforward to value. Okay? When somebody's perpetuity doesn't look like today, it becomes a little more challenging to value sometimes. Those are some of the exceptions. Now, last week when we were doing a couple valuations, we did an exception where the WACC was a little too high. Okay? And we talked about how the WACC needed to be adjusted to get to a reasonable spread. Here, I don't think the WACC is the problem for Royal Caribbean. Okay? The problem is the ROIC. Okay? The perpetuity ROIC for Royal Caribbean, given their current share price, is too low. So you would have needed to adjust that number right there, the continuing value ROIC, to be above 8.2%. Okay? So I'm going to tell you how I did it. I'm going to ask you if you've heard of Oasis. What does Oasis mean to you in terms of Royal Caribbean? Somebody got to know about the company in order to do these valuations. If I say Oasis, what's important with Oasis? What is Oasis? Did anybody do any research on Royal Caribbean? It's hard to do this analysis without it. What is Oasis? Nobody knows what Oasis is? Yeah, go ahead. It's going to be the biggest cruise ship in the world. And it's an Oasis class, so it's going to be more than one of them. Now, is Oasis sailing today? The answer is no, it is not. They're building this ship, which is going to cost well over $1 billion, and it doesn't launch until next year. And they're going to build 2 more of these. Not just this Oasis ship, but they're going to build 2 more, which are going to be the biggest cruise ships in the world, each of them carrying over 5,500 passengers and almost 3,000 crew. Right? These are monster big ships that are extraordinarily expensive. Right? That's key. Here's why. They're spending billions of dollars. How much revenue is being generated from these 3 ships that don't sail right now? 0. So when we do our valuation, you will notice in ratios that to do this valuation, you needed to do a balance sheet adjustment. Previously, we've said leave the balance sheet alone. Here, we can't really leave the balance sheet alone. Because the problem is this ratio of invested capital to sales, which pre-pandemic had been 2.14, 2.24, going forward, it's closer to 2.7. And that's why their ROIC is so low. Okay? Because they're spending a huge amount on their balance sheet, a lot of invested capital relative to sales. Okay? Much more than they did pre-pandemic. And part of the reason why they're spending more invested capital sales is because they're building more expensive ships, but these ships that they're building aren't yet in service. So if I spend billions of dollars and I don't generate any sales, I get a whole lot more invested capital relative to my sales. Now, when these ships get into service, they're going to fill them up. and they're going to get a lot of sales on these ships. So the invested capital sales ratio is probably going to start coming down. So that's the point. Right now, the big spend is on their ships, and they're spending almost 317.7% based on last year's sales on ships. And if we roll that forward, you're going to get a low ROIC because it's not the margin, it's the huge invested capital that's dragging down their ROIC. As a matter of fact, well, that's the point. What do I change? Do I change the ROIC to get a positive spread in perpetuity because that's the way they're being valued today? Do I change the margin? Do I change the ROIC? Well, given what I said, I'm more likely to change the invested capital, okay? Because if I look at the perpetuity margins, first, the analysts are expecting their margins to go up over time. These are premium ships, premium prices. But more importantly, in perpetuity, the trading multiples suggest an EBITDA margin of around 35%. So they've already expected in the multiples for that margin to go up. So to get to a positive ROIC, making that even higher seemed to me harder to justify than making the invested capital to sales ratio lower. So what I did, because this could take a couple of years for these ships to come into play, is I started cranking down the invested capital to sales ratio by lowering the PP&E to sales down to a perpetuity 260% ratio. Now, 260% in my perpetuity year is higher than the 240% pre-pandemic. And I left it at 260% for a reason. And the reason I did is because these are bigger, more expensive ships. So because they're building bigger, more expensive ships, I do think they're spending more to generate $1 of sales than their smaller ships before these showed up. However, they're also getting premium prices. So I still think they're going to get leverage on them. I just don't think they're going to go back to the PP to sales ratio that they were pre-pandemic. That's my assumptions. That's my reasoning. You could have said that they're going to get that premium sales and they're going to fill them up and that they're going to get back to pre-pandemic levels, and I would have accepted that too. But what we're not going to accept is if you left the 317% PP to sales ratio unchanged, because that's what's causing challenges with your valuation. And that's why I chose Royal Caribbean. And if you didn't figure out that they were building these Oasis class ships, you wouldn't have been able to figure this out. So this is what's key to your as is. By lowering the PP to sales in perpetuity, by lowering the invested capital sales, that got to a positive spread. Now, when I got to a positive spread, I got to 9.2%. So it's not like they're making 15, 20% on these ships. That's another thing to understand about the cruise ships. They're going with a very high investment strategy to drive sales and to drive margins. That's the strategy. That's the bet that they're making. Okay? So they got to fill these ships. All right? Now here's the other thing. This is historical data, and I don't know if it's still the same percentage, but a few years ago, both Carnival and Royal Caribbean were operating on the premise that only 10% of Americans have ever been on a cruise. That number might be slightly higher now, but that's the point. They both believe, and Royal Caribbean is making the bet, that the pie could grow substantially for people that are willing to cruise. Okay? That's the bet. That's the growth bet. Right? In order to fill these ships, you're going to need more passengers. More people will cruise. Right? So in order to do this, that's why Royal Caribbean in particular is building these mega ships, because they're basically floating cities. It's like floating around for Vegas for a week. Okay? They have casinos. They have high-end restaurants. They have Broadway shows. In fact, one of their ships actually is called Central Park. It looks just like Central Park, so you can leave New York without leaving New York. Okay? They got water slides and other events. I mean, you can do a lot of stuff on these ships, and because they're so big, you don't feel seasick most of the time, right? Like a smaller ship. So long story short, they're making a bet that that will attract more people. Fill these ships, all right? And so that's the point. With a 9% G and a 9% ROIC and a 8.2% WACC, they need a lot of growth. 6.92% is the solvable G in order to basically justify the current valuation of the company. But they're betting on that growth, and this is how they think they're going to get the growth. All right, questions about anything I've said so far? Yes?
Why you're not assuming the rate for the pre-pandemic?
Assuming which rate?
So when you're trying to do the CBRIC, why you don't adjust the rate for the pre-pandemic period?
Well, I don't adjust historical numbers because they're historical. Like the numbers pre-pandemic are historical. So the question is, what does that perpetuity look like? And I'm using the pre-pandemic numbers to kind of infer the post-pandemic numbers in perpetuity. But that's the point. I think that they're slightly changing their strategy post-pandemic because they're continuing to build even bigger, more expensive ships at an even higher margin than what they were getting pre-pandemic. That's what the bet is. And I think the market, based on this as is giving them credit for that. They're giving them credit for their EBITDA margin to continue to rise, 35% in perpetuity, right? At no tax rate, by the way. So that's the point. That's already built in to their current share price, right? But what's not going to be built in is efficiency in the ships. If we don't put efficiency in the ships into our model's not going to catch the current share price. We're going to have a hard time explaining the as is. But in any model that you come in which proves the ROIC, your ROIC is not going to be 15, 20%. Right? They're going to have slightly more than a break-even spread, which means they need a lot of growth at this relatively low spread to justify their current share price. That's going to inform my bull and my bear. I'm not going to hand out the bull and the bear, but here's how I'd start to talk about it. As I'm thinking about the bull and the bear and reading the Royal Caribbean, I'm going to go back to what happened in the airline industry 10 years ago. So Boeing and Airbus introduced these monster jets. One was called the A380, and the other was called, I forget what the other version was, but basically Airbus came up with two planes that basically had about 500 to 600 passengers they could squeeze on the plane, okay? And it turned out that these were disasters. The airlines bought these super jumbos to fly these international routes and tried to make a ton of money on them. The problem was, just like Royal Caribbean has to cruise a ship and fill a ship for 363 out of 365 days a year, the airlines needed to fill these 500-600 passenger planes every day. And in order to fill those planes every day, they started discounting. Because I don't want to fill a plane 300 people if it holds 600. I need to put every passenger I can on that plane. And they started heavily discounting. So very quickly, the airline industry abandoned these super jumbos because they realized that even though they could fit a bunch more passengers, if they couldn't fill it all with premium price passengers to fill it at their capacity, they were actually losing money because they had to discount so much to get people to fly these planes. So they stopped buying these planes. And then the whole airline industry went back to smaller planes, the 787, the A350. Those are now the popular international jets, but those are 250 to 300 passenger jets, not 500 to 600 passenger jets. And it's just more efficient for the airline. Make sense? The reason I tell you this story is I think that's the story of the bull and the bear for Royal Caribbean. Because they got to fill up 5,500 passengers times 3 ships at premium pricing, every cruise. And if they can't do that, that's the bear scenario. In my mind, they're making a big bet on these super premium ships, that they're going to fill these super premium ships with super premium prices. And if they have to discount heavily to fill these ships, they're not going to get the 35% EBITDA margin, and they're not going to get their valuation. And when you start putting in a more historical EBITDA margin for the size of these ships and what it does to their invested capital sales, you get a share price in the 30s. That's my bear scenario. And so my bear scenario is they kind of get the growth, but they get it at a low price, or worse, they don't get the growth. And they don't get all these people to go cruising that they thought are going to come cruising in the future to fill the ships. So if one of those two things happen, that's the bear. Okay? So what's the bull? The bull is that they fill the ships with super premium passengers. And by the way, when I start looking at where they are today, that bull looks a lot like the current share price. So I'm going to basically probably put a bull that's not too much higher than the current share price. Might be 75, 80, and my downside might be 30. I think there's more downside to Royal Caribbean right now than upside. Okay? I'm not saying they can't achieve the upside, but what I'm just telling you is they have to convince more people at super premium prices to come in. Now, don't get me wrong, these new ships are really nice, and they're hoping to attract a much higher end crowd. Because like I said, they have custom restaurants, not just the buffet. They have lots of entertainment. Like I said, disclaimer, went on a Royal Caribbean cruise. I saw Hairspray. It was a Broadway show. So, they have some pretty high-end stuff on these ships, right? But that's the point. That's the key leverage point to their share price, because these ships are so darn expensive. And they're just putting so much investment to basically build these ships. And that's the risk. Carnival, by the way, is taking a different approach. Carnival is basically buying cheaper ships. Not as big, cheaper ships. They're still big ships, just not nearly as big. And they have more of them. So basically, Carnival's basically saying, I don't want to have to fill up a 5,500 passenger ship. I want to fill up a 3,000 passenger ship, which is still a lot, but I don't think I want to take the risk of potential discounting. So that's Carnival. Their strategy is a little bit more lower end in terms of the value they need per passenger and the total amount of passengers they need. Don't know who's going to play out, but that's the difference between the two companies. Questions about that? Somewhere in there should have been your as is, your bull, your bear. My target is a hold or a sell because I actually think they're either fairly valued or premium valued. So my target's going to probably be closer to or below the current share price. So I'll cruise Royal Caribbean again. I get lots of discounted offers. That's another reason why I'm probably biased. But at the same time, I'm probably not going to want to buy their stock. Not right now. Okay. Let's talk about multiples. Lecture note 6. We're going to talk about multiples, also known as comparables or comparables. Right? And it's just an alternative form of valuation. Now, we remember there's law of one price. We've said it multiple times this semester. Just because you change your approach doesn't mean you get a different answer. So there's one value for the company, regardless of how we're doing it. And so what we're going to realize is that multiples are a simplified approach to DCF. I like to call it the Cliff Notes. And when we do multiples analysis, we're kind of working backwards. With a DCF, we are putting in assumptions. What's going to be the growth? What's going to be the ROIC? What's going to be the free cash flow that comes out of that? What's the discount rate? And that leads to an intrinsic value. With multiples, we start with the actual price of the company, and then we work backwards. And then we say, based on the price of the company and price of other companies that are similar, what should this company be worth? In order to do this, multiples look at prices of similar assets that are benchmarks for valuation. In your personal life, the first time you'll probably experience a multiple is if you ever buy a house. Because when you buy that house, you're going to have to get an appraisal. All right, here's what the appraiser is going to do. They're going to look in the last 6 months of similar houses near yours that have sold. And they're going to look at the price of all those sales. And then they're going to take the square feet of every one of those houses. So let's say that the average house sold at $400,000 and the average house had 2,000 square feet. So they're going to take the $400,000 price divided by the square foot and get a price per square foot. That's a multiple. Okay. In this case, 400,000 divided by 2,000 square feet is $200 a foot. Okay. So when they value your house, let's say your house has 2,200 square feet, they're going to take 2,200 times 200, and that's the starting point for the appraisal. Right. And then what they're going to do is they're going to adjust it up or down based on their criteria. How many bedrooms, bathrooms do you have? What's the age and condition of your house versus those other houses? What's the size of your lot? How big is it? By the way, where on the street are you? Are you in a cul-de-sac or are you in the middle of a heavy intersection with a lot of traffic? Okay. They're going to look at other factors. School district are you in? Does it change versus some of the others? So they're going to put all that together and they're going to slightly adjust that price per square foot up or down, and then that's what's going to lead to the appraised value of your house. Well, the same is true for companies. Okay. So what we're going to do is we're going to look at their profits or earnings, and we're going to say this level of profit leads to that level of multiple. Multiples are an expression of growth and spread. So what is your growth and spread versus other growth and spreads? And then that's going to lead to the different prices or multiples that we see in the real world. The advantages of a multiple approach is, number one, since they're based on real world companies, I think that the banks prefer those over DCF valuations. Let's say that you do a merger and you bought a company and it goes awry and you sue your bankers. The bankers are on the stand. The lawyers are questioning the bankers. So justify your valuation that was wrong. Well, we looked at similar companies of what they were trading for, and we based the price of this company that you bought based on those similar prices in the real world that we observed on this day. Versus, tell me why this valuation was wrong. And the answer is, well, in my DCF model, I used an ROIC for these reasons. I used a WACC for those reasons, and I used a terminal growth rate for these reasons, and that led to the valuation of which I was wrong on. Which of those two is more defensible? right? And what I'm telling you is banks like multiples because they're far more defensible than the DCF. Now they'll do both, right? But multiples are based on the real world, and that's the point. I got a real world data point I can point to for another company. When I compare, I'm compared to that company. That's why I'm worth what I do. That also allows you to value private companies. Because I could say, if a private company were trading publicly, based on what similar public companies are trading at, this is what that private company should approximately be trading at. And I can infer that. I can do the same thing with mergers and acquisitions. Those are called precedent transactions. Here's what I should use to pay for a company that I'm buying based on what other companies have sold for. So for example, if you haven't paid attention to Bloomberg, MA is the merger and acquisition database. Every deal, every price is in this database. So I was reading yesterday that Merck is buying this biotech company in the Wall Street Journal, almost $10 billion. So for example, if I search the M&A database for Merck, on Sunday, April 16th, Merck announced they were buying Prometheus Bioscience for $8.839 billion in cash. So there's the deal. It was announced last night. If I click on this deal, here's a summary of the deal. Here's the timeline to completion. Here's the parties involved. Here's the deal structure. Here are the advisors. Interestingly, Morgan Stanley was the financial advisor for Merck. That was the only thing listed this morning. Since then, their legal advisors are Paul Weiss, Rifkin, Wharton for Merck, and Centerview Partners was apparently hired by Prometheus to represent them in this deal. So again, those are the firms that are representing them. This is news about the deal. Here, deal comps. Here's the multiples. So just like the house, in a deal transaction, what Bloomberg will do is, here are similar biotech companies that have been acquired historically that are similar to Prometheus. Total value is the price. Enterprise value to EBIT, total value to EBIT. Enterprise value to revenue, total value to revenue. Enterprise PE, price to earnings multiple. All those multiples, based on the historical deal prices, are right here. So there's your deal multiples. You also have trading comps. Here are publicly traded biotechs and the multiples that they're trading at based on share prices today. Here's the company Prometheus that they're buying. So you can use that to do a relative valuation of the deal. Now, Prometheus doesn't look like any of these publicly traded companies because Prometheus doesn't have any sales. All of their products are stage 2, 3 pipelines that are promising drugs to be released, but they haven't sold anything. You can't buy any of their drugs yet. So Merck is actually making a very early stage bet, and they're paying a lot of money for this company, right? And that's, again, you can play out the trading multiples. But nonetheless, those are called precedent transactions. The challenge with multiples, two things. One, we're oversimplifying the company to 3 or 4 numbers to represent the long term. We've already approached this in DCF, but we're doing it even more extreme when we do multiples. Second, finding peers is extraordinarily difficult. Okay? Here's an example. Let's say we're doing Disney, and we want to compare Disney against its peers. Well, Netflix will be a peer, all right? Because Disney has a streaming service, and Disney has content production, and Netflix has a streaming service, and Netflix has content production. So Netflix would seem like a reasonable peer for their streaming business, but that's not all Disney does. Disney's got theme parks. Netflix doesn't have theme parks. So if I'm going to compare the theme park business at Disney, that's not Netflix. That's going to be Comcast. Comcast has Universal Studios. Disney has Disney World. Okay, I compare theme parks with those two businesses. But Comcast is also a cable company. They have a big cable business and an internet business, which Disney does not have. So I'm comparing Comcast with Disney, but that's only part of Disney, and it's not even all of Comcast. And oh, by the way, Disney has a cruise line. So Disney's cruise line competes with Royal Caribbean and Carnival. Now it's buried in the Disney results, but Royal Caribbean doesn't have a theme park, and Royal Caribbean doesn't have a streaming and entertainment movie business. See my point? So that's the problem. Like when you start doing peers, it's much harder than it seems because it's very hard to find pure play companies that are just doing the same exact thing for for publicly traded companies, right? We love it when we can find them, but it's actually harder and harder to do. So we have to compromise. And even the BICS list you'll see for Bloomberg, the default peers, start looking at some of these companies like, why is Marriott Hotels and Hyatt Hotels a peer comparison for Royal Caribbean Cruise Lines? I mean, you can argue that they're basically floating hotels, but that's what you have to do. Otherwise, there's not a lot of peers for Royal Caribbean, as an example. Does that make sense? All right, so this is one of the challenges with multiples, finding true peers that are represented. Number two is because multiples are based on growth and spread, you actually want to find companies that have similar growth and spread. So if you can't find similar growth and spread, that becomes another challenge with multiples. So for example, if I'm valuing Microsoft and I'm valuing an early stage software startup, they're going to have far different expected growth rates and far different expected returns because Microsoft is more mature than a growth company. So it's just harder to compare, even if they're in the same industry. So I got to be careful with that. And then finally, I got to worry if companies have drastically different capital structures, because capital structures affect PE, right? And even though PE, price to earnings, is one of the most commonly used multiples, it's one of the hardest to explain, because PE, price to earnings, is based on net income. Net income is GAAP income, which means it has non-cash items in it. It's got one-time charges in it. It's got debt in it. It's got taxes in it. It's got operating expenses in it. There's a lot of things that go into a net income. And if I'm trying to explain net income across companies, I got to account for all those differences. So ironically, even though PE, price to earnings, is one of the most commonly used multiples, it's actually one of the hardest to explain, right, in terms of differences in a comparable analysis across companies. This semester, these are the steps that you're going to follow, which are best practices, by the way, to doing a multiple analysis. Number one, this is the hardest part. Find a reasonable peer group. Okay? So if I don't give you the peer group, finding the peer group is actually the toughest part. Right? Now for this next assignment, I'm going to give you the peer group. Yes, sir?
Could you break it down by sector?
You could. But as I said, if you go to Disney right now, which you will have to do later, and you go to RV, I can look against Disney's peer group for entertainment. I'll go to Algo here. Here is film and TV, which has one group of peers. Here is entertainment facilities, which is another group of peers. So you could do that. But here's the challenge. Disney is still one company. I can't slice off Disney's entertainment business versus their film and TV part of their business. I still have one Disney, which is an average of the two. So even if I'm looking at Six Flags, which is more pure play, that's just the theme parks. Disney is the average Disney, which is more than theme parks, even when I still look by sector. So yes, this is what we will do, but nonetheless, it's another limitation we've got to realize we're facing. Good question. Other questions? Back to our process. 5 steps. Number 1, figure out your peer groups. Okay. Number 2, get your data. All right. And we're going to use forward data, not historical data. That's why you need Bloomberg. All right. The reason why we're using forward data is forward multiples are more predictive of valuations because it's about future cash flows. Okay. Number 3, calculate the multiples based on the forward data. Number 4, benchmark, explain the differences. Why companies trade at premiums, which means higher than their peers. Why companies trade at discounts, which means lower than their peers. And then finally, use that to establish ranges for companies. One of the other key points about multiples is it's more about the range than the absolute results. Okay? Because we're oversimplifying. Best practices, we've been talking about those. Ideally, find companies when you do peers that have similar growth and ROIC, growth spread prospects. 2, forward-looking multiples. 3, enterprise value multiples are preferable to PE multiples. Right? Not that they're perfect, but generally enterprise value multiples are less susceptible to accounting differences, non-operating items, and differences in capital structure. And then finally, if you do have a lot of non-operating items, accounting differences or capital structure, understand you might have to adjust the multiples to actually be more comparable. So for example, if Disney announced this massive restructuring and they're going to get rid of 30,000 people, then their numbers are going to reflect that one-time loss associated with that. That's going to affect their earnings, that's going to affect their PE. So we need to recognize that when we look at a Disney PE on a go-forward basis, that might actually make it look worse on an earnings basis than what it would be after that reorganization one time is over. So therefore their PE today might look different than their PE tomorrow. They can also be used for precedent transactions, think M&A. And these are the multiples we're going to cover this semester. For simplicity, I normally do four multiples. This semester, I'm only going to hold you accountable for 3. The 3 multiples that you're going to have to calculate and explain are PE, price to earnings, EV to EBIT, and EV to sales, also known as EV to revenue. Those are the 3 multiples. I'm excluding EV to EBITDA, just for simplicity. Okay. So let's talk about multiples. Multiples are based on the key value driver equation. If you remember, this right here is the key value driver equation. We use it all semester. So here's the idea. I'm going to create a table of results plugging in numbers to the key value driver equation. There are 4 parts to the key value driver equation. No plat, 100 million. WACC, 10%. ROIC, 6, 8, 10, 12, 14, and 16. So I'm going to vary it into that equation. G, 1, 2, 3, 4, 5. Okay? So if I plug in those 4 numbers, I get those results to the table. So 100 million in no plat, 10% WACC, 2% G, 8% ROIC, 938 million in value. Okay? If I plug in 100 million in no plat, 10% WACC, 4% G, 14% ROIC, $1,190,000,000 in value. Okay? And finally, if I plug in 100 million in no plat, 10% cost of capital, 10% ROIC, regardless of my G, 1 through 5%, I get $1 billion of value. Why does that number stay at $1 billion as the growth changes from 1 to 5%? Why does that value, why does that result not change? Yes, sir. Yeah, and if it's equal to WACC, we know from earlier you're growing a zero spread, and growing a zero spread doesn't have any impact on value. And so that's the results. We see it right here in the key value driver equation. Everybody with me so far? So here is a multiple. That, because we use key value drivers, is enterprise value. Because here's the assumption. Enterprise value is free cash flow. Free cash flow is operating value. If a company doesn't have non-operating value, the operating value equals the enterprise value. Okay? So we use this as a proxy for enterprise value. So here's the idea. I take EV to EBIT as a multiple. How do I do it? Well, if I have 100 million in no plat at a 35% tax rate, I have 154 million, 154 of EBIT. Take 100 divided by 0.65, I get 154. Okay? So what is my EV to EBIT? 1 billion divided by 154 million is a multiple of 6.5 times EBIT. 893 million, which is 8% ROIC, 3% growth, divided by 154 is 5.8 times EBIT. 16% ROIC at 5% growth is 1375 value, divided by 154 is 8.9 times EBIT. So that's enterprise value to EBIT. We just take the value divided by the profit, essentially a price to earnings multiple, what's called enterprise value to EBIT. Everybody with me so far? So here's my question. What does it mean to have a 6.5 times enterprise value to EBIT multiple? What does that mean? If a company in this industry has a 6.5 times EV to EBIT multiple, what can we infer? If they're trading at 6.5 times EBIT, what can we infer? If they're multiple 6.5 times EBIT,
Yeah.
why? Why is it trading at 6.5? What can we infer financially about that? Someone want to help out? Why isn't it trading at 7 or 6 or 8? Why is it trading at 6.5? What must be true to be 6.5? Regardless of the growth. Why is it trading at 6.5 regardless of growth? Why does this company have $1 billion of value regardless of growth? Because they have no spread, right? Why are they trading at 6.5 regardless of growth? Because they have no spread. So a company, given this data, that has a 10% ROIC, 10% WACC, regardless of growth, zero spread, is going to trade at 6.5 times EBIT. So everybody see that? It's important to your analysis. Got it now? All right. Follow-up question. Two companies in this industry. Company number 1 trades at 6 times EBIT. Company number 2 trades at 7 times EBIT. Financially, what's the difference between a 6 and a 7 in this industry? Why would a company be trading at 6 times EBIT? What could we infer? Companies at 6 times EBIT. What could we infer? Yeah. They likely have a negative spread. Because what growth spread combinations get you to 6? What gets you to a 6? All right, this is a 6. 1% growth, 6% ROIC is a 6. What about what's another 6? What growth, what ROIC is also a 6? Here and somewhere in the middle there. So here's the thing. I can have a 1% growth and a 6% ROIC, and I can trade it 6 times EBIT. I can have a 2% growth and an 8-ish ROIC and have a 6 times EBIT. So I could actually have anywhere in that range and still get to the same answer. That's why I told you earlier that multiples are more about the ranges. Because you can't tell me that this company in the future is at 1 and 6 or 2 and 8. But I know somewhere in the 1 to 6, 2 to 8 range is likely where this company is going to end up. That's the point. But the real point, one level up, both of these are negative spreads. So I know that this company has a negative spread. I know that this company's not expecting a lot of growth at a negative spread, and that's why they're trading at 6 times EBIT. Everybody follow that? Why is a company trading at a 7 times EBIT in this industry? Where are my 7s? 7, 7, somewhere between the two. 7, somewhere in that range. It's supposed to be more of a straight line. I'm a terrible drawer of my mouse. But what can we infer about a company with a 7? 7 times EBIT. That one, they're going to have a positive spread at relatively low growth. And again, I don't know if it's 1, 2, 3% growth. I don't know if it's 12, 14, 16% ROIC. But somewhere in that low growth, higher ROIC range, positive spread, is the company trading at a 7 times multiple. That's EV to EBIT. We do the same thing with PE. Here's the difference. When we do a price to earnings multiple, it's based on equity. It's based on net income. Same key value driver equation. The difference is we take NOPLAT and replace it with net income. We take ROIC and replace it with ROE, return on equity. The growth is no longer the growth in free cash flow, growth in NOPLAT. It's the growth in net income. And we discount it not at the WACC, but we discount it at the cost of equity. So same equation, just plug in equity values. So, next page. 100 million of expected income, net income, 10% cost of equity, different return on equities at ROICs, different growth in equity, growth in net income. These are the values in this table. So same process, 10% ROE, 10% cost of equity, $1 billion of value. That's 10 times earnings. Billion divided by 100 million net income, multiple of 10, or that's a PE of 10. Okay? So similar concept in this industry, if companies have a PE of 10, they have a break-even spread. So growth is not going to create any value. Same concept, if my PE is below 10, I likely have a negative spread. If my PE is above 10, I likely have a positive spread. That brings up to another point about multiples and the naivete that professionals on CNBC will be spouting out even today. You got to be careful about what you learned in your previous finance classes. This is more advanced, but here's the point. Should be obvious now. People will make the following comment. This company has a PE of, I'll make it up, 10, and this other company and all their peers are trading at 15. You should buy this company trading at 10 because they're on sale. They're cheap. They're trading at a discount. And because their peers are trading at 15, they're eventually going to trade at 15 and you can make money. People will say that. You were taught to say that. You'll eventually trade at the industry average. That is a naive statement. The reason why a company trades, looking at this table, at a PE that's 13 versus a PE that's 10 is because they have a higher growth spread combination. So that's the point. The reason why you're trading at a discount is because you have a lower growth spread combination. That's why you're trading at a discount. If you're going to trade at the industry, you have to improve either the growth or the spread. If you don't improve the growth or spread, you're not just going to arbitrarily trade where everybody else does. And that's the point people often forget when they talk about multiple analysis. Like, that's the idea. You're going to improve your results. That's what's going to cause people to want to pay more for you. If your results don't change, your multiple's not going to change. Okay, same thing. If your results get worse, you're going to start trading at a lower multiple over time. Okay, so discounts or premiums are not just buy it because it's cheap. It's cheap for a reason. Okay, it's cheap because it's an underperforming company. That's why it's cheap. You want to do better? Start performing better. That's what's going to be key, and that's what we're going to start to see in our analysis. Again, does that make sense? So companies just don't go to the average. Average means average growth, average ROIC. If you don't have average growth, average ROIC, you're not going to trade for the average. Yes?
So if you're comparing, like, say, three companies that are
Which
performing,
we're about to do, but go ahead.
yeah, pretty similarly, then, like, wouldn't that be like a leg comparison? So,
That would be an easier comparison, because if they have three similar results, they should have three similar multiples. Exactly. But that's exactly where we're going to go next. We're going to compare three companies. That's the spreadsheet I want you to then open. So in class, oh, sorry, one more slide before I get there. So just very quickly, the third multiple is enterprise value to sales. And I showed this to you a few weeks ago. We were building our DCF model. But basically, this is the key value driver equation. This is how you rearrange it to get the enterprise value to revenue multiple. Enterprise value to revenue divided by enterprise value to EBIT is our long-term margin. Okay? But the whole point is, EV to revenue multiples, EV to sales multiples, are primarily driven by margin. Okay? Because here's the simple idea. How much am I worth when I sell my next dollar? The reason why people will pay for more sales is because I make more on that sale. So generally, higher EV to revenues are indicative of higher enterprise, higher margins. Okay? So just as an example, if I look at the margins, operating margin as of the latest filing for these entertainment companies, some of them are trading at from 8 to 20%, like they're fairly high. If I look at companies like Walmart to this list, what am I going to do? Operating margin, because I can't change it without this. But the point is, if I were to put in Walmart, Target, Costco, which we're about to look at, their operating margins are like 3 to 4%. I can tell you the EV to sales multiples, EV divided by sales, or EV to revenue. There you go. EV to sales multiples for these companies are 2 to 3, which means I pay $2 of value for every dollar that they sell. The EV to sales multiple for Costco, Walmart, and Target, just because that's what we're about to do, are 0.7 to 0.8. So that's the point. When these discount retailers sell $1, they generate 70 cents in value. When an entertainment company sells $1, they generate $2 plus in value. Okay? Because the margins on Disney and those entertainment companies are much higher than the margins on Walmart. EV to sales is proxy for margin for most industries. Okay? So those are the three multiples that we're about to analyze. So let's talk about the spreadsheet. This is the second spreadsheet with the data filled in. This is the data as of this morning for Costco, Walmart, and Target. Your goal for your analysis, for your homework, and eventual group project is basically to take the company that I assigned, in this case Costco, compare it to its peers, in this case Walmart and Target, and tell me why each of those three multiples is trading at a premium or discount to Costco. A premium means two tabs. First tab is the PE tab. Costco's PE this morning was 31.45. Walmart's PE was 21.84. Costco is trading at a premium to Walmart's PE. It's higher. Walmart is trading at a discount to Costco's PE. It's lower. Target is also trading at a discount to Costco's PE at 15. Our next part, why? Okay, why are Costco's PEs higher than Walmart and Target's? We got to explain that. So starting with the PE, there's three drivers of the PE, growth and spread. This is the key value driver equation here. Now, when you fill this out, and I've already filled this out, you're going to get your data from Bloomberg. Okay, so I'm going to tell you how to get the data from Bloomberg that filled out this sheet. So this morning, I'll start out with Costco. This is their PE. The first screen that I went to is I went to Costco. And I went to the screen called WAC. And when I get to the screen, I'm going to take a screenshot because I got to submit my screenshots with my data. No screenshots, no credit. Okay. Two data points on here. Here's Costco's WAC, 9.1%. Here's Costco's cost of equity, 9.3%. So cost of equity, 9.3% from the WAC screenshot. WAC, 9.1% from the equity WAC screenshot. Then, since I'm already here in Bloomberg, I went to Walmart and I did the same thing. WMT US equity for its WAC. Save the screenshot that I'm going to be submitting. 7.2% WAC, 7.9% cost of equity as of this morning. This is my 7.2% WAC for Walmart. This is my 7.9% cost of equity for Walmart. I then went to Target, did the same thing. Target, WAC screen, take screenshot, screenshot number 3, WAC, cost of equity 10.1, WAC 8.9. Okay, so that's where those 6 data points came from, the WAC screenshots for those 3 companies. Next, back to the PE tab, I go to my EEO screen. Start with Costco. Go to EEO. We've talked about this before. I care about forward multiples. I don't care about historical multiples because, again, forward multiples are more predictive of future cash flows. in this class, we talked about how the second forward year is more standardized because that's the first clean forecast year. So, in Bloomberg, actual, forward year 1, forward year 2. This is the column we're going to use for our multiple analysis. Just to be consistent, we're going to do all multiples based on forward year 2. So right now, what do I need to fill out for Costco? This is their forward year 2 PE. Right now, price to earnings, forward year 2, 31.55. So actual PE, 31.55. That's the number I would type in here. Now you might say, gee, it's 31.45. And the answer is because I did that this morning. And that's why you need screenshots. Okay, because I can take a screenshot of the CEO because during the time of day, Costco's share price, as is Walmart's share price, is constantly changing, and these multiples change in real time. They'll also change day by day if you do it in a different day. So as of this morning, it was 31.45. If I did it right now, I do it 31.55. But just to be consistent with the earlier classes, I'm going to leave this at 31.45. But that's where the data point came from. Okay. Next, I need a net income for Costco. This is the second forward year net income. 1, 2, net income adjusted, 69.37. 6,937,000,000. Enter that in for Costco right there. Okay. Finally, on the EEO screen, you can scroll down or you can minimize. But if you never paid attention, there's more data down here that the analysts are forecasting. This is a forecast for the next 4 years of return on equity for Target. Last year, next 4 years. Now, just like Royal Caribbean, I need a proper spread in my perpetuity. Otherwise, my multiple analysis isn't going to make sense. So I need a realistic ROE in perpetuity. So let's look at Costco's last year, next 4 years. Last year, their return on equity was 31%. This year, 28, then 26, 24, 25. Okay? Pretty stable over the next 4 years. So I'm going to pick 25%. You could have picked 24, 26, but somewhere in the 24 to 26 range is probably a realistic ROE for Costco going forward. I picked 25. Everybody with me so far? Okay. So what would have happened is your spreadsheet would now look like this. Okay? And so what you would do, just like we've done in our DCF valuation models, is I would go to Tools, Goal Seek, and I would basically solve for the G that makes these two PEs, the one with the key value drivers and the observed one in the market, equal to each other. Using those goal seeks, and I'll undo, these are the 3 Gs. Okay, so basically just solve for the G, because I now have my spreads, and I'm making the PE in our model match the PE in the real world. I've already been doing this with EV to EBIT. Finally, before I do my analysis, I go to the EV to EBIT tab. Same thing. I need my EV to sales and my EV to EBIT for Costco. Either scroll up and or maximize if I minimized. Here's my EV to sales or revenue. Second forward year, 0.83. For Costco, EV to EBIT, second forward year, 23.29. Again, slightly different because I did it this morning and their share price today is up $1.87 since this morning. So therefore, it's going to be a slightly lower EV to EBIT, the higher share price. But nonetheless, put in the current data, repeat this process for Target and Walmart. Okay? So we don't have a G. This would be blank. We then need a tax rate and we need an ROIC. Okay? For tax rate, same process as DCF. I go to guidance, GUID. Costco has given tax rate guidance 26%. 26%. While I'm on the screen, look at Walmart. Walmart has given tax rate guidance. 26%. Somebody's 26%. Target doesn't give tax rate guidance. Go to BRC, look up JP Morgan. 22%. Operating ROIC. It's the same idea. I need a spread based on ROIC in perpetuity. Generally, for these companies, what you're going to realize, and I'll do Walmart as an example, when you did the EEO for Walmart, similar to the EEO for Costco, the ROEs for Walmart were pretty stable. 19, 20, 20, 22. Okay? Target's going to look the same way. They're pretty stable. So here's the point. ROIC and ROE are somewhat connected. Because here's the point. ROIC is profit over invested capital, which is debt and equity. Return equity is profit over equity. If I multiply P over D plus E times essentially D over E, debt cancels out, and I get return on equity. So what drives return on equity is the leverage ratio. So here's the point. If the ROEs are pretty stable, and the leverages are often pretty stable, then the ROICs are pretty stable. Okay? Which another way of saying is the ROICs today for these three companies look a lot like the ROICs tomorrow. So I'm going to use the ROICs today in my perpetuity. If that is not the case, if you're doing a company like Royal Caribbean, where last year's ROIC does not look like the perpetuity ROIC because of what they did with their balance sheet, you can't do what we're about to do. You'd have to come up with a realistic ROIC in the future or a realistic ROE in the future in order to complete this analysis. So my last step for Costco is to go to the RV screen. I go to custom, I go to my spread template, which has my operating ROIC on it, and I'm going to use the current operating ROICs for the three companies in perpetuity. So last year, the operating ROIC for Costco was approximately, give it a second to fill in, 26.53%, Walmart 9.61%, Target 9.34%. Those are those three numbers. Goal seek, solve for the G's. Those are the G's. Questions about the data collection. These are steps 1 and 2. Now I explain. Why, starting with PE, is Costco's PE 31.45 and Walmart lower at 21.84? These are the three things that drive PE. This is what I'm explaining. First, Costco has a higher spread. 25 minus 9 is about 16 points of spread. Costco, 16. Walmart, 21 minus 8 is about 13 points of spread. Costco has a higher spread going forward. Costco's growing that higher spread at 7% a year. Walmart's growing that spread at 4.25% a year. The reason why I'm paying more for Costco is because they have a higher spread and they're growing it much faster than Walmart. Does everybody see that? So that's pretty clean, pretty easy. Except there's one more thing at work here, and this is the part that people often skip. Costco has more risk than Walmart. Their cost of equity is 9.3%. Walmart is 7.9%. All right? I want to show you something. The difference between 9.3 and 7.9 is 1.4. Okay? So what I'm going to do is I'm going to lower Costco's return equity by 1.4% to 23.6, and I'm going to lower its cost of equity by 1.4% to 7.9. So I'm keeping the 16-point spread. But watch what happens to that multiple with a 16-point spread at the same cost of equity. Their PE would be 79. So the third thing that's working in this explanation between Costco and Walmart is benefiting by their lower risk. Because remember, we're discounting cash flows. And when we discount a cash flow at a higher rate, it's worth less. When we discount a cash flow at a lower rate, it's worth more. So Costco is trading at a premium to Walmart because they have a higher spread, about 16 points, faster growth, 7% versus 4.25, but that's offset by the headwind of more risk at Costco versus Walmart, which is why it's only a 31.45 PE, not a 72. Does everybody understand and see that? Why is Costco trading at a premium in a PE to Target? Well, Target has a higher spread than Costco, about 30 points, 40 minus 10. But Target doesn't have the growth of Costco. They have the slowest growth in the industry at 4.19% versus 7%. So much lower growth of that higher spread is why Target is trading at a discount. Target also has more perceived risk than Costco, 10.1% cost of equity versus 9.3, which is further reducing their PE and further making it more of a discount. That's what's happening with Target. Now that I've explained my PEs and my 500-word write-ups, I'm now moving on to multiple number 2, which is enterprise value to EBIT. Now I'm dealing with operating values, not net income. So these are the 4 variables to EV to EBIT. So I got to explain 4 things as to why these numbers are different. Why is Costco trading at a premium to Walmart, 23.2 versus 16.83? Well, first, one of the new items is tax rate. They're both paying 26% tax rates, so that's not going to affect any difference. They got the same tax rate. So I don't have to worry about tax rate as a differentiator. Costco has a higher spread than Walmart. 26.5% ROIC versus 9% WAC, 9.6% ROIC, 7.2% at WAC. Costco's clearly got a much higher spread. Costco, like in the PE, is expected to grow faster, 6.7% with that higher spread versus 5.17% of the lower spread. That's why Costco's trading at a premium. However, Costco still has the headwind of the higher WAC, right? Again, if Costco's WAC were the same as Walmart's, their EV to EBIT multiple would be 115. Okay, so what's offsetting the higher multiple for Target or for Costco is that they have higher risk, and that is influencing these multiples. Costco against Target. Why is Target trading at the lowest multiple in the industry? On an operating basis, they have an even lower spread than Walmart. They have the lowest spread of the 3. 9.3 versus 8.9, close to break even. Which means this high growth that explains the low spread to get to their multiple doesn't matter that much because I have high growth at close to a 0 spread. So that's just not worth a lot. Despite the fact that Target has the highest expected growth in the industry, they're growing it at close to 0 spread, so it's just not worth that much. Now, they are paying a lower tax rate of 22%, so that does benefit them. That does help their multiple, but not enough to overcome the fact that the real problem with Target is that low spread. And similar risk to Costco, 8.9% WAC versus 9.1. Now, interestingly, when you take out debt and equity, Target is a little bit less risky than Costco. When you put in debt and equity, PE ratio, Target is more risky than Costco. That's the influence of the debt. Target has more debt than Costco. And there's a little bit more risk because of that debt. That's how it plays out in the cost of equity. Everybody following? Final multiple. EV to sales. Multiple number 3. I told you that EV to sales is basically how much value you create when you sell that next dollar of sales. Generally, Costco gets 83 cents of value when they sell something. Walmart gets 70 cents of value when they sell something. The bias should be because Costco has higher margins. Well, the multiple suggests that Costco does not have higher margins. Costco's expected margin in perpetuity is 3.6% pre-tax. Walmart's margin in perpetuity is 4.2 cents in perpetuity. Walmart makes more margins than Costco, Why am I paying more for Costco sales? This doesn't make sense. Costco's invested capital to sales ratio is 0.1. Walmart's invested capital to sales is expected to be 0.32. Basically, Walmart is spending 32 cents per dollar to generate the dollar of sales. Costco is spending 10 cents per dollar to generate the dollar of sales. Walmart is spending 3 times what Costco is to generate those sales. And therefore, we'll get a much lower ROIC in those sales. And that is why people pay more for Costco sales than Walmart, because even though Walmart makes more in every sale, they're spending 3 times as much to make that sale, and that's what's causing the lower EV to sales multiple. Why is Target better than Walmart but still below Costco? They have the highest margin in the industry, 6%, almost double pre-tax what Costco's is. But the problem with Target is they're spending 50 cents per dollar on sales. So again, they're spending 5 times as much on investment to generate sales, even though they have a higher margin. People only pay 80 cents per dollar for those sales. So yes, the bias is that margin drives EV to sales, EV to revenue, but that's assuming the productivities are the same. That's assuming the WACs are the same. If those differentiate, those play into all of these analyses. That's what you would have had to explain. Those are the things that we need to do for the comparisons on 3 companies. That'll be your next homework assignment. As I said, I'll post it after the next class. I don't want to post it now because then I wanted you to pay attention to what I was talking about. And then Wednesday is a lab day. So you have all day Wednesday to come in here, get the data, and do the fill in the spreadsheet, get the screenshots. All right, this one you're not exporting data to Excel, so it should be a little bit easier. Then you have to do the same walkthrough that I just did, minimum 500 word paper. Turn in your screenshots, turn in your Excel model, turn in your paper, and that's what's due next Monday in addition to your Nokia presentations. Nokia team presentations due next Monday. Feel free to use Wednesday's class to meet with your team to prepare for Nokia as well. All right, and just like we talked about for Royal Caribbean, I'll give you a disclaimer. I work with Nokia. I know something about this company. So if you come in here and you show me a bunch of numbers and you don't tell me anything about why that they're different, I'm going to be very skeptical and I'm not going to grade you as well. So context is important in your evaluation. It'll also be important eventually in multiples. So 10-minute presentations next Monday, papers for homework 12, which is extra credit, next Monday, no lecture on Wednesday. Yes? Question? Yes. All right, can I go over which formulas?
The formulas for the model.
Oh, that's the key value driver formula, which we put into our spreadsheet. I just put it in here for you. So it's the same as it's in the DCF, the EV to EBIT multiple. All right, I'm going to put this. Did I not do attendance?
No.
Damn it, the second time I forgot to do attendance. Everybody's here today. Sorry. My fault.